Welcome back to another video here at FiscalVoyage. My name is Felix, and in this video we're going to do a stock analysis on Enbridge Inc., ticker symbol ENB. This video was suggested, or this company was recommended from C North. C North is a good subscriber of mine. He's always watching and commenting my videos. I appreciate you, C North. Thank you for recommending Enbridge. Enbridge is a midstream company transporting oil and natural gas. It looks to be very attractive right now. It has the dividend yield of 8.4. The valuation looks very attractive, and in this video we're going to do a stock analysis on this company to determine if it's actually a good, attractive company, and if it's a buy, sell, or hold at current prices. Before we do that, if you're new to the channel, make sure to hit that subscribe button, and as well check out my free ebook in the description below, 5 quick metrics to look for before you spend more time in any particular company. All right, Enbridge, ticker symbol ENB. The company is one of the biggest midstream companies in North America, has a diversified business model transporting oil and natural gas while also building out its renewable energy portfolio. Also, this company pays out in Canadian, is a Canadian company, and it pays out Canadian dividends. So just be aware of that when you receive dividends from this company, there is some conversion or transaction fees for that. So let's look at the fundamentals for Enbridge. The company grew revenue at a very nice rate at 14.2% for the 10-year period from 2010 to 2019. Net income grew at an even better rate at 21.8% in that same time frame. The company currently has the S&P credit rating of BBB+, investment grade rating, real good credit rating there. Operating income grew at 21.5% in that 10-year period. However, operating cash flow, since it's a midstream company, we look at operating cash flow, and operating cash flow per share growth for that 10-year period was 4.3%. So operating cash flow grew much slower than revenue and net income. However, revenue for the past 5 years is slowing down. 5-year average is at 10.3% compared to the 14.2% for the 10 years. Net income for the past 4 years average real good growth at 40.2%, double of the 10-year period. Operating cash flow for the past 5 years has been trending down at 1.9%. However, analysts are expecting a nice 5% growth, and we're going to talk about that later in this presentation. So let's continue with the fundamentals. 2019 operating cash flow per share came in at $3.51. Net margin was 10.6% for 2019, and is actually was much better than the 5.4% in the company net margin for 2018. So they did an improvement. However, the trailing 12 months net margin is down at 4.4%. Most likely has to do with the oil prices hitting zero earlier this year, and very low oil prices. Return on equity at 6.4%, past 5-year average, so the company tends to be around that area. The current yield is very attractive at 8.44%. Very attractive current yield, and the good part is the company's been growing that dividend yield for the past 5 years at 11.8%. Nice double-digit dividend growth, and the most recent increase was 9.8% in December of last year. So December, I'm expecting a nice dividend increase. I wouldn't expect a 9.8% increase like last year, but maybe a 5 or 6% increase. I could totally see that happening for this company. The company does have a nice payout ratio of 62% on operating cash flow, so that's very positive. So again, that's why I think the dividend is going to be increased later this year, about 5 or 6%. And they've been growing dividends for 24 consecutive years. So that's why I'm very confident that this company is going to increase it sometime this December. The 5-year dividend yield average is 5.26%. So you can see the current yield at 8.44% might be a good indicator that the company is undervalued just based on the dividend yield, almost 300 basis points higher. The balance sheet looks good for this company as well. Debt to cap at only 47% is quite in the middle there, modest debt to cap ratio. The current ratio is at 0.6. It is low based on my criteria of 1.5, but because this is such a capital intensive business, this current ratio is in line with the past 5-year average, so I'm not too concerned with that. Debt to equity ratio at 1.1. It's not great debt to equity ratio, but it's very manageable. Interest coverage at 2.1, manageable there as well. And the price to book here looks very attractive. You can see the price to book ratio at 1.3 versus a 5-year average of 2.3. So it's another indicator that the company may be undervalued based on the price to book ratio. So I look at future outlook for this company. 2020, analysts are expecting operating cash flow to come in at $3.86. Much higher. I wouldn't say much higher, but 30 cents higher, 34 cents higher than 2019 at $3.51. So it is an improvement. So that's very positive considering the shutdown, the oil price debacle that we had earlier this year in March. So that's very positive news there. And then 2021, they're expected to jump even higher at $4.28. So that's very promising. A lot of analysts, what I researched, are projecting about a 5% operating cash flow growth for the next 3 years. So that's positive news. Using my dividend drill return model projection, total return about 8%. I think this is going to be higher because of the valuation, and the current yield is about over 8%. So not sure why this came out like that. It might be because I was using operating cash flow, but regardless, the dividend drill return model came up at 8%. But I think it's going to be much higher. Price to operating cash flow currently is at 7.7, and forward looking is at 7.6 based on 2020 expected earnings. So that's positive there. Versus the 5-year price to operating cash flow average of 9.7. So you can see here, there's another good indicator that this company is undervalued based on the price to operating cash flow. So let's go look at the fast graph for this company. Again, ticker symbol ENB. As you can see here, this was yesterday's closing price at $28.96. The dividend yield outstanding 8.55, very attractive yield. Blended operating cash flow yield at 13.06%. This is like the adjusted earnings yield, but based on operating cash flow, very attractive here at 13%. Again, blended price to operating cash flow at 7. Triple B plus credit rating, long-term debt at only 47%. As you can see here, the earnings has been erratic for the past maybe 8-10 years, but it is on the upward trend. As you can see here, earnings has been growing on the long term. And you can see here for 2020, analysts are expecting about a 10% increase in operating cash flow from 351 to 386, like I mentioned. And for 2021, another 11% operating cash flow growth at 4.28. You can see here the company has been trending down since 2015. You would have lost about 44% of your capital, but with the dividend, total loss would have been 24%. This is why valuation is so important. You can see here I had a price to operating cash flow of 16. But now we have a price to operating cash flow of 7. So this makes this company very attractive at current ratio. If we look at the 10-year chart here, and based on returning to a normal price to operating ratio of 10, you have a total annual rate of return of about 31%. That's outstanding. This is including capital appreciation and the dividends of 8.55 and growing dividend at that. So if we look at the past 10 years, you can see the company has been growing dividends very nicely. 27% in 2010, 14% in 2022. It had a low growth in 2014, but pick it up the next 3-4 years. 2019 was 9.4%, but like I mentioned, in December of last year, they grew it. This is based on U.S. increase, where in Canada they had a 9.8% increase in Canadian dollars. So this is why it came in at 7.4%, because it's converted into U.S. dollars. So if we go back to this graph, you can see here how the company tend to follow again the normal multiple of 10, and right now we have a low price to operating cash flow of 7.6 or 7.7. So again, very attractive based on the fast graph. If we look at the analyst scorecard, they're pretty accurate with the estimates. 64% hit with an 18% beat of the company and only miss 18%. And the same thing for 2 years. So I'm very confident with these analyst expectations, considering that the shutdown and the oil prices, it dropped the price very low at that time period. It was about a 28% loss in price. So when that happens, if nothing really fundamentally changed, I'm sure earnings dropped from that time period if we look at forecasting. So yeah, the earnings did drop. Last 6 months ago, they had estimated $3.90. Now they're estimating $3.86. So it is an improvement from 3 months ago of $3.80, but did drop slightly by 2 pennies. But now, with the economy, almost back open fully, things are picking up. Oil prices is picking up around $40. They're expecting, they probably could predict this much more accurately. So this is why I'm very confident with these estimates. All right, the fair value price slide here. Very, very promising, actually. Look forward to this. CFA has a fair price about $40. Morningstar at 43. Fast Graph, as you saw, $40.06. This is based on 2021 expected earnings. And Yahoo at $45.03. And my dividend discount model analysis at $52.87. So what I used here, I was very conservative here. I did 6% dividend growth for the next 3 years and 5% after that with a discount rate of 10%. So that came out with $52.87. So averaging out the 5, we get a fair price of $44.19. And currently the company going for at $29.39. That means the company is undervalued by 50.4%. Outstanding valuation there. This is why I have Enbridge stock as a buy at current prices. So there you have it. Enbridge is a buy recommendation. Again, when I say a buy recommendation, doesn't mean go out there and buy it. It means for you guys to do some more research on the company. It looks very attractive. I think spending more time in researching, you'll find that it is very attractive at current prices. I personally own shares of this company. I'm down about 4% or so, but overall I'm up because of the dividends. I've held it for a few years. I bought it, I think 2 or 3 years ago when it was about this price range. So basically flat, but the dividend has been paying out, but I'm positive in that front. As you saw, revenue has been growing very nicely. Past 5 years, 10%. The trailing 12 month is slightly lower than 2019, but it's still expected, as you saw, operating cash flow to be up 10% for 2020 and up another 11% for 2021. So the company is heading in the right direction. The share price is compressed, of course, because of the shutdown, less people using energy with transportation, things like that. The oil prices earlier this year, but overall I think this company is heading in the right direction. Price will eventually follow the operating cash flow as it normally does. So that's why I think this company is a buy. Again, a buy means for you guys to maybe spend more time and evaluate this company. It's a good company to invest your time in and look further into this one. So I hope you enjoyed the video. If you have a particular company you would like for me to evaluate, analyze next, leave a comment below with the name of the company and ticker symbol, as well as make sure to subscribe if you're a new visitor to my channel. I appreciate coming by. And also check out my free ebook in the description below. And I'll see you guys in the next one.